Okay, let's look at two ratios that companies use, or that we can use to evaluate a company's position. First one is called the debt ratio. This tells us what percentage of a company's assets are actually financed with liabilities. Obviously, a high debt ratio can be troubling because a company may not be able to pay all their debts as they come due. Some companies or some industries, though, do tend to run very high debt ratios. Interest coverage ratio is another ratio that tells us a business's ability to pay the interest on its debt as it comes due. So let's talk about each one of those more specifically. So the debt ratio is just total liabilities a company has divided by total assets. So it tells us again how much of a company's assets are actually financed. Interest coverage ratio, we're going to take our earnings before interest and taxes. Sometimes we have to calculate that by adding back in the interest expense and the tax expense because the earnings we get are net income. And then we divide that by our interest expense. So it's basically giving us an idea of how many times a company can pay the interest on its debt as it comes due. So here's an example we have. Thompson Industrial Supply had the following balances as of December 31st, 2012. So if we're going to do the debt ratio first thing we're going to need to do is add together our total assets, which is going to be current plus long-term assets, and then we get current plus long-term liabilities. So we're going to take the total assets divided by, total liabilities divided by our total assets. Here's another graph, you can see that. So if we take our total liabilities, add those two together, divided by total assets, that gives me a debt ratio of 70%. So 70% of this company's assets are actually financed with debt. Then if we look at the interest coverage ratio, remember that's earnings before interest and taxes. In this particular example, it's already calculated for you, divided by the interest expense. So this is a ratio of 1.62 times. So this particular company can pay the interest on their debt 1.62 times with their earnings.